On August 15th, 1971, at 9 p.m. Eastern Time, President Richard Nixon appeared on national television and in 15 minutes severed the link between the U.S. dollar and gold, a connection that had anchored global commerce for nearly 3 decades. Yet within weeks, foreign exchange markets went haywire, currencies fluctuated wildly, and the financial order that rebuilt Europe and Japan from wartime rubble simply ceased to exist. How did the system designed at Bretton Woods in 1944 to prevent another Great Depression become so fragile that one presidential decree could shatter it? And why did breaking it ultimately concentrate more wealth in American hands than the gold standard ever did? The answer lies in a documented chain of events that transform money itself, from a promise backed by metal into pure faith in government power. Welcome to The Wealth Timeline, where we uncover how money, power, and history are woven together to shape the world we live in. Today, we trace the verified rise and calculated destruction of the Bretton Woods system, revealing how its collapse reshaped global wealth in ways that still govern our economy in 2025. In July 1944, as World War II raged across Europe and the Pacific, 730 delegates from 44 Allied nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. Their mission was urgent: construct a monetary framework that would prevent the competitive devaluations and trade wars that had deepened the Great Depression in the 1930s. The architects, British economist John Maynard Keynes and U.S. Treasury official Harry Dexter White, proposed rival visions, but American economic dominance, holding 2/3 of the world's gold reserves at 20,000 metric tons, ensured White's dollar-centric plan prevailed. The agreement established fixed exchange rates, with the dollar pegged at $35 per ounce of gold, while other currencies fixed their rates to the dollar. The International Monetary Fund was created to oversee this system, and the World Bank would finance post-war reconstruction. For the first time in history, a single national currency became the global reserve, backed by America's explicit promise to redeem dollars for gold on demand from foreign central banks. This arrangement reflected wartime realities. Europe's industrial base lay in ruins, Japan was occupied, and only the United States possessed the productive capacity to supply goods worldwide. But even at its inception, tensions simmered beneath this elegant structure. Would America maintain discipline in its money supply when domestic political pressures mounted? Could any nation sustain such responsibility indefinitely? The Bretton Woods system formally commenced in December 1945, after ratification by member nations. Initially, it functioned as intended. European economies, devastated by war, required massive dollar inflows to purchase American machinery, food, and raw materials for reconstruction. The Marshall Plan, launched in 1948, channeled $13 billion in U.S. aid, roughly $173 billion in 2025 dollars, into Western Europe, deliberately creating what economists termed the dollar shortage. Foreign nations desperately needed dollars for trade, and America's commitment to gold convertibility made those dollars as good as bullion. Through the 1950s, this arrangement facilitated unprecedented growth. West Germany's economy expanded at 8% annually during its Wirtschaftswunder, or economic miracle. Japan's GDP grew 9.7% per year on average from 1955 to 1970, according to World Bank historical data. Fixed exchange rates provided stability for international trade, which tripled between 1950 and 1970, as documented in United Nations statistics. American corporations established global supply chains, confident that currency fluctuations wouldn't erase profits overnight. The mechanism worked through arbitrage. If a currency deviated from its fixed rate, central banks would intervene, buying or selling dollars and gold to maintain the peg. The IMF stood ready to provide temporary liquidity to nations facing a balance of payments difficulties. This created a self-correcting system, in theory. But the foundation contained an inherent contradiction identified by Yale economist Robert Triffin in testimony before Congress in 1959. The Triffin Dilemma exposed a fatal flaw. For global trade to grow, the world needed ever-increasing dollar supplies. Yet maintaining confidence in dollar-gold convertibility required the U.S. to limit dollar creation. America faced an impossible choice: satisfy global liquidity needs and risk gold reserves, or protect gold and strangle world commerce. Initially, this seemed manageable. In 1950, U.S. gold reserves stood at 20,000 metric tons against $28 billion in circulating dollars, maintaining comfortable coverage. But as European and Japanese recoveries progressed, the dollar shortage reversed into a dollar glut. American military spending abroad, maintaining bases in Germany, Japan, Korea, and elsewhere, pumped dollars overseas. Foreign aid programs and corporate investments did likewise. By 1960, dollars held abroad exceeded U.S. gold reserves at the fixed $35 price. The arithmetic was straightforward and alarming. At 19,507 metric tons of gold in 1960, the U.S. could theoretically redeem only $21 billion worth of foreign-held dollars, yet $20 billion circulated abroad, according to Federal Reserve historical records. The cushion was vanishing, and sophisticated observers recognized the implications. Through the 1960s, the Bretton Woods system demonstrated growing strain even as it continued facilitating global prosperity. The Kennedy administration, taking office in January 1961, confronted mounting pressure immediately. Private speculators, betting on dollar devaluation, purchased gold in London markets, driving prices above the official $35 rate. In October 1961, the U.S. organized the London Gold Pool, a consortium of 8 central banks coordinating to suppress gold prices through market sales. This intervention worked temporarily, maintaining the official price, but it drained American reserves. Meanwhile, domestic policy priorities conflicted with international monetary obligations. President Lyndon Johnson's Great Society programs, launched in 1964, dramatically expanded federal spending on Medicare, Medicaid, education, and anti-poverty initiatives. Simultaneously, American military involvement in Vietnam escalated. Troop levels rose from 23,000 advisors in 1964 to 536,000 by 1968, with annual war costs reaching $28 billion by 1968. Roughly $246 billion in 2025 dollars per Department of Defense records. These twin commitments, guns and butter, required deficit spending. The federal budget deficit reached $25 billion in 1968, the largest peacetime deficit since World War II. To finance this, the Federal Reserve expanded the money supply, with M2 growing 7.9% annually from 1965 to 1970. More dollars chasing limited goods triggered inflation, which rose from 1.3% in 1964 to 5.9% by 1970, according to Bureau of Labor Statistics data. Foreign central banks watched with alarm. The dollars accumulating in their reserves were theoretically convertible to gold, but doing so would trigger the system's collapse. French President Charles de Gaulle, skeptical of American monetary discipline, began converting France's dollar reserves to gold in 1965. Between 1965 and 1968, France redeemed $3 billion for gold, explicitly challenging American dominance. Germany and other nations, more diplomatically, expressed concern through IMF channels. U.S. gold reserves hemorrhaged. From 15,821 metric tons in 1961, they fell to 10,192 tons by 1968, a 31% decline in 7 years, as documented in Treasury Department records. On March 17, 1968, facing unsustainable gold outflows, the London Gold Pool collapsed. Central banks established a 2-tier system. Official transactions continued at $35 per ounce among governments, while private markets traded freely. This compromise acknowledged reality the fixed price couldn't hold, but postponed resolution. The Nixon administration inherited this crisis in January 1969. Gold reserves continued declining, falling to 9,138 metric tons by 1971. Foreign dollar holdings surged past $80 billion, according to Federal Reserve data, creating a liability 4 times the gold backing at official prices. Throughout 1970 and early 1971, speculation against the dollar intensified. Traders anticipated devaluation, converting dollars to stronger currencies like the Deutsche Mark and Swiss franc. By summer 1971, the situation reached a breaking point. In May, West Germany allowed the mark to float freely rather than continue buying unlimited dollars to maintain the peg. This unilateral action signaled disintegration. In August, a congressional subcommittee report requested conversion of dollars to gold, publicly highlighting the mismatch between liabilities and reserves. European central banks lined up demands for redemption. Why didn't the U.S. simply defend the system through austerity, as Bretton Woods rules implied? The answer lay in domestic politics. With unemployment at 6.1% in August 1971 and inflation at 4.4%, according to Bureau of Labor Statistics figures, imposing recession through monetary tightening was politically untenable in an election year, but continuing the gold drain meant eventual default. On Friday, August 13, 1971, British ambassador to the United States requested conversion of $3 billion in dollar reserves to gold, an explicit demand that would reduce American reserves by nearly 10% in a single transaction. Treasury Secretary John Connally convened an emergency meeting at Camp David that weekend with President Nixon, Federal Reserve Chairman Arthur Burns, and key economic advisors. The decision arrived swiftly. Rather than honor Britain's request and face cascading redemptions, the United States would unilaterally suspend gold convertibility. At 9 p.m. Eastern Time on Sunday, August 15, 1971, Nixon addressed the nation in a televised speech. In measured tones, he announced the temporary closure of the gold window. preventing foreign central banks from exchanging dollars for gold. He framed this as protecting American workers from international speculators and announced additional measures: a 90-day wage and price freeze to combat inflation, and a 10% surcharge on imports to pressure trade partners. The international reaction was immediate and severe. When markets opened Monday, foreign exchange trading descended into chaos. Central banks, unable to maintain fixed rates without U.S. cooperation, either floated their currencies or imposed capital controls. The Deutsche Mark appreciated 13% against the dollar within weeks. The Japanese yen, held at 360 per dollar since 1949, strengthened to 308 by year's end. Britain imposed strict controls on sterling movements. Finance ministers convened emergency meetings through fall 1971, attempting to salvage fixed rates. The Smithsonian Agreement of December 1971, negotiated at the Smithsonian Institution in Washington, established new parities. The dollar was devalued to 38 per ounce of gold, though convertibility remained suspended, and currencies were allowed wider fluctuation bands of 2.25% rather than 1%. Nixon proclaimed it the most significant monetary agreement in the history of the world. It lasted 14 months. By February 1973, speculative attacks resumed. The dollar was devalued again to $42.22 per ounce in February 1973, still without actual convertibility. In March 1973, major economies abandoned fixed rates entirely, allowing currencies to float freely. The Bretton Woods system, designed as permanent architecture, had crumbled in less than 2 years from Nixon's announcement. Historians and economists analyzing these events through Federal Reserve archives, IMF documents, and participant memoirs identify structural inevitability. The U.S. couldn't simultaneously provide global liquidity, maintain fixed gold convertibility, and pursue independent domestic policy, the impossible trinity of international economics. When priorities conflicted, domestic concerns won, as they had throughout the 1960s. Nixon's decision was less a sudden rupture than the final acknowledgement of a decade-long unraveling. But why did this collapse not trigger global depression, as 1930s monetary chaos had? The answer would reshape international finance permanently. The immediate aftermath of Bretton Woods' collapse brought uncertainty and inflation. Without fixed anchors, currencies fluctuated wildly through the mid-1970s. The dollar fell 17% against major currencies from 1971 to 1973, according to Federal Reserve trade-weighted indices. This depreciation, combined with domestic policies, accelerated inflation. U.S. consumer prices rose 6.2% in 1973, 11% in 1974, and peaked at 13.5% in 1980, as documented by the Bureau of Labor Statistics. The OPEC oil embargo of 1973, quadrupling petroleum prices from $3 to $12 per barrel, compounded inflation, and it exposed how floating exchange rates transmitted shocks globally. Nations experienced stagflation, simultaneous inflation and stagnation, with unemployment and prices rising together, defying Keynesian economic assumptions. The UK saw inflation reach 24.2% in 1975, while GDP contracted per Bank of England records. Yet the system didn't collapse into 1930s-style depression. Why? Because floating exchange rates, however chaotic initially, provided a release valve. Countries could devalue to maintain competitiveness, rather than endure grinding deflation through gold standard discipline. Trade continued growing, reaching new records by the late 1970s, despite currency volatility. More profoundly, the dollar retained a reserve currency status without gold backing, an outcome that surprised contemporary observers. Foreign central banks continued holding dollars, not from legal obligation, but from practical necessity. Oil traded in dollars, giving every nation reason to maintain dollar reserves. U.S. Treasury securities became the preferred safe asset, offering liquidity and stability no other market provided. By 1978, dollar-denominated assets still comprised 85% of global reserves, according to IMF statistics. This represented unprecedented power. America could finance deficits by simply printing the currency the world demanded, a privilege economists termed exorbitant privilege. Former French finance minister Valéry Giscard d'Estaing had coined that phrase in the 1960s, but it applied even more forcefully post-Bretton Woods. Regulatory responses evolved through the 1970s. The Jamaica Agreements of 1976 formally amended IMF articles, legalizing floating rates and ending gold's official monetary role. Central banks began diversifying reserves, holding German marks, Japanese yen, and eventually euros alongside dollars. The European monetary system, launched in 1979, created a zone of currency stability among common market members, presaging the euro's eventual adoption in 1999. Beneficiaries of the new system included American consumers, who enjoyed cheaper imports from dollar appreciation during strong periods, and multinational corporations that developed sophisticated hedging strategies to manage currency risk. Banks created foreign exchange derivatives markets, with trading volumes exploding from negligible levels to $18 billion daily by 1980, per bank, for international settlements data. Sufferers included developing nations whose dollar debts became crushing burdens as the currency strengthened post-1980. Latin American countries faced debt crises in 1982, unable to service loans denominated in appreciating dollars. Fixed-income Americans saw savings eroded by 1970s inflation, while manufacturing workers faced intensifying international competition as floating rates exposed competitiveness gaps. Politically, the collapse discredited post-war consensus. The Keynesian policy framework, which assumed governments could fine-tune economies, gave way to monetarism and later supply-side economics in the 1980s. Central bank independence became paramount, with controlling inflation the primary mandate. The Federal Reserve, under Paul Volcker, beginning in 1979, raised interest rates above 20% to break inflationary psychology, inducing severe recession, but restoring monetary credibility. By the mid-1980s, a new international order had stabilized around floating rates, dollar dominance, and market-determined values, far different from the fixed gold-backed system of 1945-1971, yet functional and increasingly sophisticated. In 2025, the consequences of Bretton Woods' collapse continue shaping global finance in ways that would astound the 1944 architects. The dollar remains the world's dominant reserve currency, comprising approximately 58% of global foreign exchange reserves as of Q4 2024, according to IMF currency composition of official foreign exchange reserves data. This persists, despite America's share of global GDP falling from 40% in 1960 to roughly 25% today, per World Bank figures. The mechanisms, however, have evolved dramatically. The global economy operates on fiat currency, money backed solely by government decree rather than commodities. Central banks conduct monetary policy through interest rate manipulation and quantitative easing, tools unavailable under gold standards. The Federal Reserve's balance sheet, constrained to $65 billion in 1971, expanded to $8.9 trillion by 2022 during pandemic quantitative easing, according to Fed data, before contracting somewhat through 2023-2024. Currency volatility, the great fear of 1971, became normalized through derivatives markets. Daily foreign exchange trading volume reached $7.5 trillion by April 2022, per bank, for international settlements triennial surveys, a 400-fold increase from 1980. This liquidity enables instant hedging, though it also facilitates massive speculative flows that can destabilize emerging markets, as seen in the 1997 Asian financial crisis and 2018 Turkish lira collapse. The patterns from Bretton Woods' end recur in modern debates. U.S. fiscal deficits, reaching $1.7 trillion in fiscal year 2023, according to Treasury data, are financed through bond sales to foreign central banks, particularly China and Japan, which held $187 trillion combined in Treasury securities as of 2024. This recreates the Triffin Dilemma in new form. America must run deficits to supply global liquidity, yet persistent deficits erode confidence. The dollar's reserve status allows this to continue far beyond what standard economic theory suggests sustainable. China's efforts to internationalize the renminbi mirror European challenges to dollar dominance in the 1960s. Cross-border renminbi payments reached 4.7 trillion yuan in 2023, per Chinese central bank data, yet still comprise only 4.7% of global payments versus the dollar's 47%, according to SWIFT transaction data. Capital controls and limited liquidity prevent the renminbi from seriously challenging dollar supremacy, much as restricted convertibility limited the franc and mark historically. Digital currencies represent the latest transformation. Central bank. Digital currencies, under development by 134 countries, representing 98% of global GDP, according to Atlantic Council tracking, could enable reserve currency competition in ways impossible with physical money. Yet the dollar's network effects, debt denomination, commodity pricing, established trading infrastructure, create enormous switching costs that preserve its dominance. Cryptocurrency advocates argue Bitcoin and similar assets restore gold-like scarcity without government manipulation, echoing gold standard nostalgia. Bitcoin's fixed supply of 21 million coins mirrors the disciplined gold imposed on Bretton Woods, yet volatility and limited adoption prevent cryptocurrencies from functioning as stable transaction media, relegating them to speculative assets rather than monetary systems. As of 2025, Bitcoin's price fluctuates 40 to 60% annually according to market data, far too unstable for denominating trade or holding reserves. The central mystery of 1971 resolves through this modern lens. Breaking the gold link didn't destroy American monetary dominance. It untethered it from physical constraints, allowing policy flexibility that proved more valuable than gold backing. The system's fragility became its strength, adapting to shocks through exchange rate adjustments rather than rigid deflation. Yet this flexibility concentrated power. The ability to print the global reserve currency gives America extraordinary leverage in sanctions, financial regulation, and economic policy that would be impossible under gold convertibility. Reflectively, this reframes monetary systems not as technical arrangements, but as power structures. The gold standard constrained American autonomy. Its collapse removed those restraints. Bretton Woods didn't fail. It served its purpose of American dominance so successfully that it became unnecessary, replaced by arrangements serving the same end through different means. Three historically verified lessons emerge from Bretton Woods' documented history. First, fixed exchange rate systems under single currency dominance contain inherent contradictions. The provider nation cannot simultaneously supply global liquidity and maintain fixed convertibility indefinitely, as the Triffin Dilemma proved mathematically inevitable. Second, monetary regime collapses need not trigger depression if alternative mechanisms exist. Floating rates, despite 1970s volatility, provided flexibility that rigid gold standards lacked, enabling continued growth through adaptation. Third, reserve currency status derives ultimately from network effects and economic power rather than gold backing. The dollar's dominance persists in 2025 precisely because breaking the gold link removed constraints while maintaining the structural advantages that Bretton Woods formalized. The verified data is clear. U.S. gold reserves fell from 20,000 metric tons in 1950 to weight as 133 tons today, yet dollar centrality barely diminished, demonstrating that modern monetary power rests on different foundations than the architects of 1944 envisioned. Because in the world of wealth and power, history never ends. It just changes hands. If you enjoyed uncovering this hidden chapter of history, don't forget to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next story might just rewrite what you thought you knew about power.